Imagine waking up every morning knowing your money is quietly growing, not just in value, but also in income. You're not chasing risky trades. You're not trying to time the market. Yet every quarter, your bank account gets a deposit from some of the most powerful companies in the world. That's the magic of dividend growth investing, a strategy that rewards patience, discipline, and long-term thinking. In 2025, when inflation, market volatility, and interest rates dominate the headlines, investors are turning back to something simple, reliable, and proven: dividends that grow year after year. Because while flashy stocks rise and crash, dividend growers quietly build wealth in the background. But here's the real question. What exactly is dividend growth investing, and which stocks or ETFs are the best picks in 2025? Let's dive in and find out. Dividend growth investing isn't about chasing the highest yield. It's about finding companies that consistently increase their payouts over time. Think of it like planting a tree. At first, the dividends are small, a few dollars here and there. But as the company grows and raises its dividend every year, that small tree becomes a forest of cash flow. Over a decade, your income doesn't just grow, it multiplies. This strategy has created more millionaires than most people realize. Warren Buffett is one of the biggest examples. His company, Berkshire Hathaway, owns dividend growth giants like Coca-Cola and American Express, companies that have increased their dividends for decades. Buffett doesn't care about short-term stock movements. He focuses on businesses that make more money every year and reward shareholders with growing income. That's the essence of dividend growth investing. So why is this strategy so powerful in 2025? Because in an unpredictable market, consistency is king. When inflation eats away at savings, growing dividends help investors keep up. When tech stocks swing wildly, dividend growers provide stability. And when the economy slows down, companies with long histories of raising dividends tend to hold up better. They're financially disciplined, cash-rich, and built for the long haul. Now let's talk about the best dividend growth stocks and exchange-traded funds to watch in 2025. Let's start with a legend, Johnson & Johnson, J&J. This company has been paying and increasing dividends for over 60 consecutive years. That's through wars, recessions, pandemics, you name it. J&J is like the gold standard of dividend growth. With its strong healthcare business and steady cash flow, investors can count on reliability and resilience. It is not flashy, but it is the kind of stock that quietly compounds your wealth year after year. Next, we have Microsoft MSFT. You might think of it as a growth stock, but Microsoft has become a dividend growth powerhouse. It's raised dividends for more than a decade, backed by massive profits from cloud computing, software, and AI expansion. Microsoft's dividend growth rate has been over 10% annually, meaning your income doubles roughly every 7 years. That's powerful. Then there's PepsiCo PEP. While most people only see it as a soda company, PepsiCo is much more. It's a global food and beverage empire. It's raised its dividend for more than 50 years straight. Pepsi doesn't just sell drinks, it owns snack brands like Doritos, Lay's, and Quaker Oats, giving it multiple income streams. For dividend investors, that kind of stability and diversification is pure gold. Another favorite among dividend growth investors is Procter & Gamble, PG. You use their products every day: Tide, Gillette, Pampers, Head & Shoulders. PG has increased its dividend for over 65 consecutive years. That's older than most investors. The company's strength lies in its consumer staples, things people buy, no matter what happens in the economy. That makes PG a dependable dividend machine. Now let's talk about the tech space. Apple AAPL might not have the longest dividend history, but it is one of the most cash-rich companies on earth. Apple restarted its dividend program in 2012 and has been growing payouts steadily ever since. With billions in free cash flow, there's plenty of room for continued dividend growth. Plus, with Apple's dominance in devices, services, and now AI integration, investors get both growth and income. For those who want exposure through exchange-traded funds, one of the best options in 2025 remains the Schwab US Dividend Equity ETF SCHD. This fund focuses on high-quality companies with consistent dividend growth and solid financial health. It's like a pre-built portfolio of reliable income stocks. With a yield around 3.5% and strong historical performance, SCHD has become a favorite for long-term investors. Another solid ETF choice is Vanguard Dividend Appreciation ETF, VIG. VIG tracks companies that have increased dividends for at least 10 consecutive years. It's full of blue-chip names like Microsoft, Visa, and Johnson & Johnson. This ETF isn't about chasing high yields, it's about stability, growth, and quality. If your goal is slow, steady wealth building, VIG delivers exactly that. For those who want global diversification, Vanguard International Dividend Appreciation Exchange Traded Fund, VIGI, is a strong pick. It invests in international companies that have a track record of growing dividends outside the United States. That gives you exposure to markets like Europe, Japan, and emerging economies, which can add both growth and balance to your portfolio. Now, how should you approach dividend growth investing in 2025? Here's the mindset that separates winners from the rest. First, focus on the long term. Dividend growth investing isn't a get-rich-quick strategy. It's about letting time and compounding work their magic. Your wealth won't explode overnight, but give it 5, 10, or 20 years, and the results will shock you. Second, reinvest your dividends. Don't just spend them. Use them to buy more shares. That's how compounding turns a small investment into a lifetime income stream. Every dividend you reinvest is like planting another seed that grows into a future payout. Third, look for companies with strong fundamentals. A growing dividend means nothing if the company's profits are shrinking. Focus on firms with consistent earnings, low debt, and solid cash flow. That's what makes dividend growth sustainable. Fourth, avoid chasing high yields. It is tempting to buy stocks that pay 8% or 10%, but those are often red flags. If a yield looks too good to be true, it usually is. Instead, focus on moderate yields with strong growth potential. A company growing its dividend 10% annually will outperform a stagnant high-yield stock in the long run. Fifth, stay consistent. Build your dividend portfolio month after month. Even small investments compound over time. And during market dips, think of dividends as your reward for staying patient. While others panic, you are still getting paid. The beauty of dividend growth investing is that it works quietly. It doesn't rely on hype or timing. It relies on time and discipline. Your dividends grow, your income grows, and eventually your financial freedom grows. Imagine this. In 10 years, your portfolio's value has doubled. Your dividend income has tripled. And instead of worrying about stock prices, you are living off the cash flow your portfolio produces. That's not a fantasy. That's what dividend growth investing can do when you stay the course. So as 2025 unfolds, remember this. The market will have ups and downs. Headlines will scream about crashes, inflation, and tech bubbles. But dividend investors, they will keep collecting checks. Because great businesses keep paying no matter what the economy does. If you want to build lasting wealth, focus on companies and exchange-traded funds that raise their dividends year after year. They'll not only protect your money, they'll make it grow. And the best time to start? Right now. So, if this video inspired you to start your dividend growth journey, make sure to like, subscribe, and share this video with someone who needs to hear this. Because wealth isn't about luck. It's about strategy. It's about consistency. And most importantly, it's about letting your money work for you.